reason why they're going parabolically up is one reason and one reason only, that the shorts are getting their head handed to them. They're getting annihilated.
It's a classic thing that you see in trading of buy the rumor, sell the fact. The rumor was that definitely it was going to be a deal, and you got the deal, and a few hours after the deal, that was the low.
Like a perfect ideal looking TPO structure would look like, just to kind of give you an example. So each letter or block represents trading for a specific time block at a specific price. So in other words, each block represents a point in time where the market touches the price.
Social media is at the center of the tech storm right now. As I look at the social media ETF, SOCL, I get exceedingly bearish. I'm sitting here short. That ETF just provided a really nice retracement back up to moving average resistance, where literally the 50, 100, and 200-day moving averages are congregating. It failed at 34 for the second time on a rally, and that makes me exceedingly bearish. I'm literally sitting here waiting for my add to that short to kick in, which I will do below.
So this is a commodities page, scrolling down to the silver charts right here. All right. So in fact, it's doubly extreme. We've got, speculators that have a 5-year percentile of 0%. On the flip side, we've got producers and users who have a 5-year percentile of, it's not quite 100%, but it looks like it's north of 90. What that means in that category is typically called commercials. So when commercials hedge, there's 2 types of commercial traders. There are commodity producers, the entities that make the commodity, and commodity users, the entities that use the commodity. So when you hear about producer hedging, they're always selling futures because they're making something, and they sell futures to lock in future prices for their future inventory. When users hedge, they always buy because basically they're fixing the cost of their future inventory in the future.
But back in 1929, the week around Labor Day was the week when finally the U.S. gave up the ship. What was happening before that is the U.S. was in a sustained bull market. Everyone tried to get short. Everyone got their, excuse the expression, ass handed to them. All the currencies were debasing against the dollar, just like now. All the foreign markets, whatever was trading, whether it be in Great Britain at the time or France, they were underperforming massively, just like China and Germany are right now. And next week was usually the turning week with an outside reversal, which may not happen, depends on what happened today. Who knows what's going to happen, but I'm geared up because these options are really low price. I bought a ton of 2-week out and 3-week out S&P options that expire, which are ridiculously cheap. But this is where I'm going to make the stand to go ahead and sell stuff against my portfolio. This is a good risk-reward trade.
I want people to understand that's part of risk management. That's part of understanding, position sizing. If we're doing well, we'll size our positions much bigger because our P&L is positive. If we're not doing well, we just want to have a day where we put a positive P&L on the page.
There's a high probability that barring any disaster, that was going to be the low of the year. And now we're almost $7 from the peak to the valley. We were almost $6-7 off of that low, and so it's looking even more convincing that low for the year is in. The question is, where do you go from here?
I thought the data was a mixed bag, but mostly constructive, which is what the market's reflecting after last night's API by the EIA with a pretty healthy 6 million barrel draw in crude stocks, which reported draw. We had a confirmation. To tell you the truth, it's not all that surprising after the unanticipated builds we've seen the last couple of weeks.
You can see the 5-year, current gas inventories compared to the 5-year average. And, it just continues to look like this same sort of horrifying story, right? Of way below 5-year averages, inventory levels. And yet natural gas just continues to sell off. By comparison, I have a chart of Cushing inventories after today's report. And for the most part, we're kind of at lows relative to 5-6 year averages. That just goes to show you that the number doesn't really tell the story that the market is thinking about.
Euro has had a big 300 pip, a 3 big figure move back higher. The dollar has sold off. And what you saw some time ago, when dollar EM usually explodes higher, they flock. When I say they, I mean just the market in general, tends to buy dollars across the board. So what happens is a risk-on move that we've been seeing with equities breaking all-time highs is the dollar's been selling off